welcome back to this week's Manager's Thoughts, coming to you from Kelly at Synergy Asset Management. It is February 10th, 2023, and we're super excited to bring you some economic updates. Alrighty, so following the tidal wave of economic data we've been having so far in 2023, this week was definitely a bit more calm and mellow. And so as of close Thursday, we saw the S&P 500 end down just about 0.7%, the NASDAQ Composite down about 0.8%, the Dow Jones Industrial Average down about 0.6%, and the 10-year U.S. Treasury yield just about flat. And so like I said, quiet week, nothing too crazy going on, but there's definitely still things I wanted to bring to your guys' attention and talk about this week. Kind of flowing into our next topic here, I just wanted to bring your attention to the year-to-date returns of kind of the major indexes that we've been following. And so the NASDAQ Composite has gained a whopping 12.6% so far this year. The S&P 500 has gained a nice 6%. The Dow Jones has gained almost 2%, and the 10-year U.S. Treasury yield is down about 4%. We've been seeing the major success stories really stemming from growth stocks, which the NASDAQ is definitely heavily tilted towards, and this is kind of the opposite trend that we've seen in 2022, with the largest losers being those growth stocks. So definitely an interesting trend, just we wanted to bring that to your attention, and that'll flow nicely into the next thing I wanted to talk about. So yeah, like I was just saying, there's been a lot of shifts back to growth stocks this year. And so I think one of the major reasons behind this is the Fed's funds rate is coming closer and closer to its peak. As the Fed scales back to that 25 basis point rate hike in the last February meeting, and as investors are kind of guessing on when they're going to stop those rate hikes, is there one more, is there two more, are we going to see rate cuts in 2023? Everything is really unsure, but one thing for sure is that we are definitely closer to the Fed funds peak than we are last year. So that explains a little bit why the growth stocks have been doing better. Here you can see just the Russell 1000 growth, the blue line on the top there, versus Russell 1000 value, which is the black line there. And overall, we've seen about a 250% outperformance in the growth stocks on a year-to-date basis so far. Definitely just an interesting trend we've been seeing. Not only has the overall market seen gains like the Apples, the Googles, the Microsoft, the really mega cap names we know and love, they've experienced double-digit gains so far this year, but we've also seen other large cap names, think of Tesla, Nvidia, and Meta, you can see they're all in the chart there, have gotten at about 50% price returns just on a year-to-date basis in the last few weeks. And so these are crazy returns, and much of this is related to earnings, company sentiment, but also related to, like I said, the changing expectations of where interest rates are going to be at, which might end up a little bit lower than where the Fed was projecting last year, where they were projecting a Fed funds rate of about 5.1% for the end of the year. And so we're thinking it might be one more rate hike and sit at that 5% rate. We're not sure. It's really just unfolding as the year goes on. But much of this recent success of growth stocks has been really attributable to the interest rate plateau. As we kind of regain the overselling that we saw last year, we see a lot of earnings come out for Q4 and a lot of other quantitative, qualitative factors that have shifted so far in 2023. For example, we're looking at Meta's recently reported Q4 earnings that were fairly lackluster compared to where technology was in 2020 and 2021 in terms of growth, but kind of the framing around that where Mark Zuckerberg, the CEO, shifted into a more conservative, he's looking at cost cutting and all of those sorts of things in his sentiment. Really hopeful for the company that they can trim back on expenses and keep that revenue. Something that investors are really looking for in the growth sector. And so it's really unclear overall to see if this trend is going to continue into the new year. A lot of it has to do with interest rates, and the market overall has been really sensitive to interest rates as of lately, and the Fed and corporate earnings, inflation, anything geopolitical, and basically everything else that you know in the macroeconomic situation. So we look forward to continuing to monitor equity markets for risk on, risk off opportunities, winners and losers, as we manage and trade our portfolios per each of their mandates. Among all of the bulls and the bears and the economic data pouring in, one trend that's been pretty consistent in 2022 and 2023 is the inverting yield curve. This 10-year minus the 2-year Treasury spread is a great metric of where the yield curve is at. When it's positive, that's normal. When it's negative, that's not usually a good sign. And so here you can see that the 10-year minus the 2-year Treasury spread is at its lowest level since the early 80s, which was a period also of really high inflation, but just a very different economic backdrop, very different causes, and so we don't want to put apples to apples when they're not exactly the same. Historically, though, as you can see here, when short-term yields are higher than long-term yields, which is when this spread is negative, it's not a good sign. And so a recession tends to follow, as in the early 1980s. Here you can see that. In the early 1990s, we can see that before the gray lines, that's a recession there. The early 2000s with the tech bubble, and then here right before the financial crisis. It wasn't super negative, but it was negative for a period of time. And then here where we are today is definitely negative. So this is a leading indicator. It's not always correct, but it'll be interesting to see if this current cycle, if the negative spread here is actually a good sign of, are we going to see a recession? Are we not going to see a recession? And so definitely just really important data to keep track of as we look throughout this economy. One final piece of economic news I wanted to go over this week was the initial claims data. And so on Thursday morning, the Department of Labor released initial claims for the week ending February 4th, coming in at 196,000, which was definitely above the expectations of the 190,000 claims, which is a trend that we have not been seeing lately. Normally, the initial claims have been coming below the expectations. This is a slight increase from last week's data, up about 13,000 claims. One hand, this is definitely the trend that the Fed wants to see, but on the other hand, it's important to note that this is still a relatively low reading, given that even last summer's claims went up to about 250,000 per week, which you can see there in the chart, and that 1 week is nowhere near substantial enough to support a trend in the labor market. So just things that we want to keep track of, keep a look at, and see, if a trend does actually develop, we want to be on top of it. Like always, our managers and analysts are constantly looking at the news about inflation, any more rate hikes coming, corporate earnings as we just wrapped up this Q4 season, and all of the economic news we need to know as we head into 2023 and continue to manage our portfolios per their mandate. Thank you so much for tuning into this week's Manager's Thoughts update, and we look forward to providing another update soon.